I'm Alan Kenny with REIT.com, and joining me at the Hay Adams Hotel in Washington, D.C. for an episode of CEO Spotlight is David Neithercut, President and CEO of Equity Residential. David, big story last year for your company was the acquisition of Archstone. Can you tell us what made that a compelling proposition?
At Equity Residential, several years ago, we had embarked kind of on a new strategy with a focus for our investments in high-density urban assets. For many years, we had owned surface parked, garden-type properties, and as we thought about the future and thought about where this echo boom generation was going to want to live, work, and play, as we thought about where the jobs would be that our economy would create going forward, high-tech jobs, service jobs, media jobs, et cetera, we did look at the large coastal cities, the Sexy Six, some people have referred to them as. And over the past half a dozen or so years, we've worked very hard to sell out of our non-core assets and invest that capital into these more urban gateway cities, in these more high-density areas. And we made great progress on that. And coming out of the recession, late 2009, 2010, we bought an awful lot of assets. Early in the recovery, we spent several $billion of capital acquiring assets during that time frame. Yet, I will tell you, after that recovery, there became a significant amount of demand for those assets, and it became very difficult to continue to invest capital in those markets. And Archstone represented, for us, our share, about 21,000 units of very high-quality assets in these gateway cities in New York, in Boston, in Washington, in Southern California, San Francisco, and Seattle, which fit hand in glove with our investment strategy.
And you mentioned some of the reshuffling, repositioning within the portfolio. Can you give us an idea kind of where that stands?
Well, really, this will complete the total transformation of our portfolio. It wasn't long ago when we owned 230,000 apartment units. Today we own about 114, and frankly, after the Archstone closing, after we sold a lot of our assets to acquire Archstone assets, we may own fewer assets and units than we did going into the Archstone acquisition. But by buying Archstone, it's created an opportunity for sell assets in Jacksonville, in Orlando, in Phoenix, in markets that we had looked at long ago as markets that we thought were more commodity-type markets, and ones that we did not think would offer our investors the highest risk-adjusted total return. So this buying Archstone has created a great opportunity for us to dispose of many of those assets and rotate that capital into Archstone. In fact, our purchase of Archstone will be one of the largest 1031 tax-deferred sales that the market has ever seen. Our total purchase price for Archstone will be about $9 billion, and half of that will be funded by dispositions of our own property. And we've sold about $3 billion of assets, either sold or under contract to date. So Archstone not only represented a great opportunity for us to acquire assets in the markets that we were focused on, but an opportunity to use the proceeds from sales of our own non-core product to actually make that happen.
Okay, and now let's talk a little bit more about the apartment market in general. Housing seems to be starting to recover, and of course the residential housing crisis drove a lot of strong returns within the apartment sector. You know, with housing recovering, where does that leave the apartment sector now?
Well, I think very, very good. I think that the recovering housing is a good thing for the economy. Good things for the economy is good for jobs. Jobs is good for multifamily. So, I mean, we believe that a recovering housing is a good thing for the apartment business. And I will tell you, single-family housing can coexist very profitably with multifamily. I'm not quite sure why there's a notion out there that as single-family housing improves, that must somehow be a problem for us. And while I don't suggest for a minute that we don't have residents in our apartments today with pent-up demand to buy single-family homes, the fact of the matter is that where we've invested our capital now, we believe that the demand for single-family home ownership is less. Of our portfolio today, 41% of our units are occupied by a single person. 15% of our units are occupied today by people 55, aged 55 and over. So single-family housing improvement is an economic decision. It's also a lifestyle decision, and we believe that our residents want to live in these high-density areas with high walk scores, close proximity to public transportation, entertainment, et cetera, and aren't interested in moving 20 miles out in the suburbs because the pricing of single-family housing has recovered. So we believe that an improvement in the single-family housing business, or in the housing business in general, is good for the economy, good for jobs, and would be good for the apartment business.
All right. Well, thank you very much for your time, David.
My pleasure. Thanks for having me.
And for more on this and other REIT news and analysis, be sure to check out REIT.com.